Hi, everyone. Good afternoon. It's an honor to have Jay Belonsky with us again, and special thanks. He's talking to us from the road. He's traveling the U.S. and we were talking before we went live, and it seems that he chooses perfectly the title for his reports, and the last one, which happens to be a monthly with a lot of great charts for us to talk about. He talked about market speed and if one word could define the markets today, that was speed. So at some point, in the opening, markets in the U.S., down 2% across the board, and then Nasdaq, up 2%, oil down 10. So tell us, Jay, what this means, and thanks again for joining us from Minneapolis.
Yes. Hi, Roberto, and hello, everyone. Good afternoon, good evening. I apologize for my voice. I'm actually here in Minneapolis for a fencing tournament with my son, and I've been cheering him on the last couple of days.
Yeah.
My voice is kind of shot, so I apologize. But yes, market speed. I mean, it really struck me, Roberto, as I was thinking about the monthly, and what really was resonating is just how fast things are changing, and the confusion which it's creating amongst the investment community, right? And we've used those terms. We used thrashing about was the title of a recent Musings. We've talked about confusion in the markets. And speed has been a big focus of ours at TPW Advisory, going back to the spring of 2020 when we introduced the concept of COVID speed. And then subsequently, we introduced climate speed and analytical speed, and most recently conflict speed in the spring of 2022 to reflect the Russian invasion of Ukraine. And so today, or Friday, we introduced the concept of market speed. And market speed is the speed at which financial markets discount new narratives that are coming through the investment community. So we have two issues. One is the rate of change of the narratives, which has just been tremendous, right? And we've seen it as recently as today with the energy space and the oil space, as you mentioned. We'll talk more of that, I'm sure. But so the speed at which the narratives change, right? We go from inflation, and then like with the flip of a switch, we're talking recession. And then the speed at which the markets discount those changing narratives. So there are kind of two things going on, changing very rapidly. The narrative themselves, the market's discounting of the narratives, and the combination of those things, I think, has created a lot of the uncertainty, which has led to, what was a very difficult first half of the year. If you're long only public market investors, as we are at TPW Advisory with our model portfolios, there's been virtually no place to hide. It's been very difficult to avoid losing money in the first half of the year. And I think the market speed kind of concept really helps us understand why. And I think that's important because understanding why then helps us decide how we're going to approach it from an investment perspective. And amidst all this, I'd add one other thing, the term polycrisis. And this is a new term. It actually is not my own. I took it from a historian, a history professor at Columbia University, Adam Tooze, who does a really interesting chart book, and it's available publicly. You can take a look at it. But he coined the term polycrisis over the last week or two. And what he meant by that is a multitude of crises interfacing and interacting together, creating a polycrisis, which is a multifaceted crisis, which the Bank of International Settlements, which you know very well from your days as an analyst, BIS, referred to this as a combination of inflationary and recessionary forces that, together with financial stability risks, is historically unprecedented. And that's a quote directly from the BIS. And so I think that helps us, again, kind of understand where we are in the cycle, where we are in things. And when you get this kind of polycrisis with things hitting from all angles. When you get these shifting narratives and you get the market dealing with them at speed, you get confusion. Confusion leads to people stepping aside. People stepping aside leads to illiquidity, and illiquidity leads to exaggerated price moves, right? And I think, again, that's what we've seen over the last couple of weeks for sure. You just look at the trading volume on a number of different instruments. You look at, and I show this in the one of the charts in the monthly. I show the illiquidity in the S&P mini futures, unprecedented low liquidity. You look at the U.S. Treasury market, supposedly the deepest, safest, most liquid market in the world. Illiquidity popping its head up across the maturity curve in the Treasury space, and so that helps further explain, where we are. And so I think a lot of this is probably says if you have a point of view and you're confident in it and you can articulate the reasons why, you probably don't want to be trying to trade too much in this market. And this is something that we've talked about for some time, right? We don't want to trade because you're going to get your head chopped off. And you mentioned the NASDAQ and the S&P, up and down 2% in one trading day. Imagine, or oil or energy. I looked at XLE; it was down 5, 6, 7% today. If you're buying and selling and you top tick these, you're going to be feeling mighty, mighty bad just in the space of a day. So I think it's an environment that one needs to have a point of view, hopefully, obviously, well supported point of view. And if the market's going against that point of view, then you need to have a pretty strong stomach because it's been painful. But I don't think you want to, unless you're very adept at trading. I don't think you want to be trying to trade in and out of this market because it's very dangerous.
No, absolutely. And it's very important. So I think it would be very interesting if we went through some of the charts. There's over I think almost 20 charts in the report. We already talked about the first one, which is the market speed and how these narratives change very fast. But the other one talks about which is chart number 3, talks about the strength of the consumer and how much savings they have. And when people are nervous and we have an environment like that. I've heard a couple of people say, well, more than a couple of people saying that, as soon as the summer vacation is over, no one is going to buy anything for 6 months, given how bad, this, and how low the consumer confidence index are. And by that chart, it doesn't really seem that that's the case, right?
Sorry about that. I'm actually in a lobby and there's a little bit of noise around me. Yeah, well, the chart itself, first of all, I think it's great that you point out the charts. That's what's different between the monthly and the musings, right? The musings, usually 1,500 words, no charts, no tables. The monthly, roughly 4,000 words and anywhere from 15 to 25 charts and tables. And in this issue, we had 24 charts and tables. And as a reminder, whenever I see an interesting chart during the course of the month, I pull it and put it into a file. And when we're writing the monthly, I then go through that file. And just as an illustration, the file this month had 250 charts that I had chosen out of probably thousands that I look at, chose 250. Out of the 250, we chose 24 for inclusion in the monthly. So it's a real culling process. And I think that's one of the things that is a benefit to us as an independent advisory firm. We're not beholden to only using our company's, economist view or our company's analyst view. We can pick and choose across the spectrum. And that's something that I think differentiates us in our research process. And it's great that you're highlighting it. And so the chart that we reference here is interesting because it shows the household savings, not just for the U.S., which is pretty well known. Household savings are $17 trillion, I believe, versus $13 trillion at the end of the pre-COVID period. So household savings have gone up by multiple trillions of dollars in the United States. But we also show Canada, Japan, the Eurozone, the UK in this chart, and everyone has significant household savings. And so when people talk about recession, and granted, there has been some technical weakness in the U.S. Economy, at least, that leads people to speculate that we may have a technical recession. But let's remember two things, right? One, tremendous household savings. Two, record low unemployment. Very rare to get a recession when you have unemployment as low as it is today. And I saw some statistics that, not in the monthly, but I saw over the weekend, which shows that I think the unemployment roll in the United States today is 1.3 million people collecting unemployment as of June. Okay. And people constantly are referring to 2022 as akin to 2008, 2009. In 2008 and 9, unemployment rose to 6 million people. In 2001, unemployment rose to 3 million people. So again, today we have 1.3 million people unemployed. So to make the argument that the consumer is going to be weak at a time when you have record household net worth, record household savings, record low unemployment, again, not just in the US, but also in Europe, likewise in Japan, it just is a stretch for me to get deeply concerned about a deep recession when you have these factors in place.
Yeah, no, I'm writing it down. It's a great point, because it's as to borrow one of your expressions. This is just lazy talk, right? Saying that no one is going to buy anything in the consumer, and it's don't do the proper work of look at the numbers.
Well, there's a
Another,
lot. I mean, to be fair to people, there's a lot of numbers, and things are we're in a very unique period in time. That's the only way
yeah.
you can really put it. The data is definitely not consistent, right? I mean, you can have multiple views because the data is cross-cutting, because the narratives are shifting so rapidly, as we talked about, right? That you can argue pretty much any way you want, and I think that's why we used the term in our musings last week or 2 weeks ago now, thrashing about, because the market is really thrashing around, like trying to figure it out, and going from inflation, and then all of a sudden, within the space of a couple of weeks, interest rates fall off 60 basis points. Break evens on the Treasury, 5-year Treasury break evens are down a full 1% point, or 100 basis points. You have the commodity stocks and commodity prices rolling over 30 or 40% in a couple of weeks across the board, whether it's energy, copper, wheat, you name it, it's down 20 to 30%. It's really unprecedented. So I think investors, need to keep that in mind, that you're really dealing with a very tricky environment.
Yeah, to say the least. And now, moving on to one of our favorite stories, which is the capex boom in Europe, in the US. So, I mean, is that still the case, and how is that going? And of course, people have a big energy crisis to deal with. So,
Well,
I mean, is the story still intact?
I believe so, and we show a chart that shows this U.S. specific,
Yeah.
the net investment as a percentage of GDP in the United States, and it shows, as you'd kind of surmise, a steady downward tilt, whereas it represented 5.5% of GDP back in the 50s and 60s, and today we're at about 1%. Of GDP is used by government investment in the United States. So historically low. And I think it's very similar in Europe and elsewhere. And remember, the case for the capex boom is built on the need to deal with the 3 C's of
Yeah.
COVID, climate, and conflict. And so there's going to need to be an awful lot of money spent to deal with the 3 C's, as we've seen, whether it's ranging from regionalizing supply chains as part of our tripolar world thesis of regional integration, something we've been talking about for a decade, clearly manifesting itself today, whether it's talking about every region wanting to have a electric vehicle battery plant, every region wants to have a semiconductor fab plant, every region needs to protect its energy security, ranging from all these different issues. And much as we talk about the cashed up consumer, one of the reasons why we're still constructive on the capex boom is that corporates are also cashed up, right?
Mhm.
And there's two U.S. companies have close to $2 trillion of cash on their balance sheets. And so there's the consumer is cashed up, the corporates are cashed up, and most state and city governments in the United States, at least, while the federal government is reducing its fiscal spend, cities and states have unprecedented fiscal surpluses, which they are spending. And that further supports the capex. And in the case of Europe, we have the next gen and Fit for 55 policy mixes that are very fiscally supportive of capital expenditures. And so I think we're going to continue to see that. And then in Asia, I think here's a really important point that I don't think has gotten enough attention. We kind of have had now a desynchronizing of the global economy because we clearly have the US, which is decelerating. We have Europe, which is decelerating, but we have Asia, which is accelerating, right?
Yeah.
China is coming out of its COVID lockdown. The PMIs in June were the best that they've been in over a year. Japan is also accelerating. Its PMIs in June were better than expected and were the best since November. So Asia arguably is at a different point than the US and Europe. And that desynchronization of the between the regions, I think, is going to be one of the things that helps prevent a global recession from
Yeah.
occurring. And the fact that China is recovering and recovering aggressively here in the second half of the year, I think has got to be pretty constructive. And yet it hasn't manifested itself. And so I actually speculate in the monthly if that's not maybe going to be the next narrative, right? So we've gone from inflation to recession, and maybe the next narrative is going to be China or Asian recovery supporting the global economy. We'll see, but I don't think it's getting anywhere near enough attention how strong the PMIs were in June. Again, everyone's talking about an imminent recession,
Yeah.
but these are June PMIs. This is like a couple weeks ago data, and it's strong in Japan, strong in China.
Oh, and on top of that, there was this news today, about the infrastructure fund, $75 billion infrastructure spending in China. Of course, there is a political imperative, from Xi Jinping's
Yeah.
re-election. Myself particularly, one thing I would love to see in China, it has nothing to do with growth. It's if they if Ant Group or Ant Financial, whatever they are going to be called themselves again, files for their IPOs. I think this would be a tremendous boost for sentiment. And there were rumors that they were going to be back, a month ago, a few weeks ago. They have disappeared. So I think that can be a tremendous shift in sentiment.
Yeah, and I would agree. I think that the market's already sniffing that out, whether that
Yeah.
particular event occurs or not. And you look at KWeb. I mean, again, we have a chart in the
Yeah.
monthly that shows the China equity versus the U.S. China bottomed in April, very clearly bottomed in April, and has been making a series of higher highs and higher lows since April. And KWeb, which is the China tech ETF, has likewise been kind of leading that charge and is doing better than the broad
Yeah.
Chinese equity market, and kind of reflects that same thesis. And so, whether or not Ant Financial does an IPO or not, I think the message has been delivered, and the market has taken on board the idea that the regulatory pressure that was so manifest in China in the second half of last year, in the beginning of this year, has clearly been lifted. And so that, I think, allows investors to focus on the opportunity set, the more traditional opportunity set of growth and valuation, et cetera. And there, as we've been talking about for some time, China tech sells at about half the multiple of U.S. big cap tech. And if China is going to really accelerate here into the second half of the year off of a very low, depressed COVID lockdown base, then that should be pretty constructive for tech stocks in China, as well as stocks more broadly. And that's certainly the way we're participating in that within our model portfolios.
Yeah, no, fantastic. And the and I agree. We have a tech portfolio of Brazilian listed international stocks. Our top pick in that portfolio is Alibaba. We have Alphabet, and we're also optimistic. We have a couple of semiconductors which have not done quite well, but the top pick is Alibaba. Alibaba and Alphabet, so both of them. So, and talking about energy now, the last couple of days have been terrifying. Everybody's panicking in Germany, especially. You saw what happened to their, if anyone told me, at least, 2 years ago, that Germany's trade surplus would vanish, of course I wouldn't believe, and I would say the guy, is completely nuts, and that would happen because of energy, and. How do you see this whole situation, and especially from the perspective of climate? They're turning back on the coal plants. Is this just a 1 year thing? How does Europe get out of this situation? Can they find enough gas, towards the end of the year? How is that going to play out, you think?
Yeah, I mean, the market is shooting first and asking questions later. I think pretty clear. I mean, the hit to European equity today was pretty aggressive on the back of a pretty tough June for European equity prices, and certainly the energy space has been just I think is kind of in a state of confusion. I mean, I'll give you two data points just from today. Today, Saudi announced that they were going to be raising prices for their oil blends going into Asia, maybe reflecting the better tone to the economies of Asia. And at the same time, you have people speculating, certain investment banks speculating about $65 or $70 oil at the end of this year. I mean, the two things make absolutely no sense, right? The Saudis raising prices and investment banks talking about like a near halving, right? Oil was at 100, Brent was at $118 last week, and today it's barely at 100. I think it went out today at 102. So I mean, we're just having these monster moves, and I think again, it reflects a lack of liquidity. It also reflects in the commodity space, and this is again something I don't think has gotten enough attention. The financial buyers and traders are becoming playing a bigger role in the physical commodity space, right? So, I mean, traditionally, physical commodities are traded by the big trading houses. And now we've seen the hedge funds and others get involved in that game, in part because the moves were so significant going back to the spring with the Russian invasion and the spikes in energy prices in Europe. That brought a lot of hedge fund attention. And so now you're seeing that play out where you have the typical physical traders who are used to much smaller moves, and you have on top of it a layer of financial buyers and sellers of the commodity space, which I think is exacerbating and exaggerating the moves that we're seeing in the commodity space. But from my vantage point, clearly Europe is trying to, and I write about this at some length in the monthly, trying to balance the need to provide energy security for themselves, right? And Russia has revealed itself to not be a reliable supplier. You can argue all you want about Europe and Russia and Germany, or Europe and Germany should have done X, Y, and Z, 5 years ago, but that's beside the point. It's hindsight, it's useless. The focus is what happens going forward. And what happens going forward is that Russia has strategically, I think, made a huge mistake, which is that they've basically lost their best customer, which is Europe. Europe will no longer depend on Russia for its energy security. And that's set. And now the question is, how do we get there? And so the near term is, okay, we're going to have to turn on the coal plants because we have to make sure we get through this winter. We don't have enough time to build out the facilities to get more LNG, et cetera, et cetera. So for a limited period of time, we're going to have more coal. And we show the chart in the monthly on climate is of the carbon permits. which today got whacked 4%. Because people were talking about imminent recession in Europe,
Yeah.
as opposed to burning more coal, which will be more polluting, which will require more permits, which will raise the price of permits and thus raise the price of KRBN. So that's the chart we showed, and we showed the KRBN or the carbon permit pricing in Europe in the climate section of the monthly. And so I would look at it like that look, let's not let the perfect be the end, or the good be the enemy of the perfect, right? I think I got that right.
Yeah.
Coal burning right now is not great, but it's better than running out of energy in the middle of the winter, right? So that's that's a pretty straightforward.
Especially because of the eventual political consequences, and
Right. Well, the consequences have already been determined, right? Europe
yeah.
is not going to go back. Whether Russia decides to fully shut off gas, I mean, I think there's some sort of a maintenance issue coming up in the near term, and people are speculating that something is going to be shut in one of the pipes for maintenance.
It's Nord Stream 1,
Yeah,
which apparently
Nord Stream 1.
depends on some turbine
Yes.
that comes from Canada. Well, it's a Siemens equipment, but apparently it has some Canadian parts made in Canada. So they there's all the political story.
Yes. Yes, exactly. So there's a lot of speculation. I mean, that's what we're reduced to. You and I talking about a turbine with parts from different places that, let's be honest, we don't really know much about that. We can't add a whole lot of value. So again, it's kind of what we talked about at the beginning. Let's have a framework. Let's have a point of reference as to what we think is going to happen. And then let's try and help navigate ourselves through that point. And let's try to be positioned properly on a risk basis for that environment. So our view is that Europe is going to separate itself from Russian energy, period. It's a matter of national security. It's going to take time. In the interim, we're going to do some things that we'd rather not do, like burn coal, but we're going to get through it. We're going to have enough gas. Again, we're speculating here in the beginning of July about the gas storage for Europe in November and December, 5-6 months from now. Who knows what's going to happen? Right now, they're actually on track to have the storage that they want, which I think is 80% capacity by November.
Yeah.
As I understand it, they're on track to meet that. The fear is that if Russia shuts the gas, next week, that they won't be able to reach that point. In which case, then they'll have to ration and shut down various plants and recession and et cetera, et cetera, et cetera. A lot of that arguably is already priced in. Do you really want to, are you now going to sell your European positions because you've woken up and realized that, hey, this energy issue may lead to subpar growth in Europe? I mean, remember, and I make this point in the monthly as well, the 5-year average growth for Europe, GDP growth, the 5-year average leading up to COVID was 1.3%. The ECB's most recent GDP forecast for this year and next year is above 1.3%. That's not to say that they can't lower it further. They can't be wrong. But I think we have to remember, pre-COVID, Europe wasn't really growing. It grew at 1.3% real GDP in the 5-year average up to 2019. So even today, with the reduction in expectations, the ECB at least is forecasting higher growth than that. So our view is that we will get through this. Energy security is paramount. The climate issue is going to take a slight back seat to the need to make sure we have enough energy and storage, so coal burning, etc. That should be beneficial for things like KRBN, which is our carbon play. And over time, that energy security and energy independence is going to make Europe not only stronger strategically, security-wise, it's going to facilitate the transition from fossil fuel to clean energy. Let's remember, and we highlight this in the monthly, over the last 2 weeks, Europe committed to 2 specific climate issues. One was the carbon border adjustment mechanism to protect their own industries. That's key. And the second was to commit to no new sales of internal combustion engine vehicles at
2035, yeah.
2035. Those are two commitments that were just made that shows that as Europe walks this narrow path between near-term security and capacity risks and longer-term clean energy desires, they're doing both. And so I think Europe deserves a lot of credit for the way they're handling this. And again, most of the critiquing is about stuff that should have been done 5 years ago. Very few people are critiquing what should be done now, because it's hard to argue that they should be doing something other than what they're already doing.
Mm-hmm. No, this is a great point. And so if we move on to chart 6, talks about inflation, and let's try to cover all the charts that we want. So it looks like the next narrative in the markets will be I wouldn't say deflation, but disinflation, especially a lot of people talking about demand destruction. If oil was at 120, I don't know, 3-4 days ago, or 2 weeks ago.
It was 4 days ago, 119 Brent.
Yeah, exactly. And now Brent barely above 100. So, depending on what happens to supply, plus all the recession fears, it can be at 90, whatever. So people may be talking about this inflation soon. And maybe that's something that's badly needed to break inflation expectations, right?
Well, I mean, again, it's the rapid change in narratives, right? And I write in the monthly that this is a rate cycle for a market speed era, because our rate cycle has gone from inflation through the roof in a 2-year move that, again, we show in the monthly unprecedented rate of increase in the 2-year Treasury bond over the last 6 months, and then boom, somebody flips a switch. And the 2-year goes from 340 2 or 3 weeks ago to 282 today. I checked just before we went on air, 282. So that's a 60 basis point move in a 2-year instrument in the space of about a month. Just absolutely unprecedented. And at the same time, I think I mentioned earlier, the break evens, the 5-year break even has also completely collapsed and is back to, I think, 2.6%. So there is the market. People talk about how the market's lost faith in the Fed and the Fed has no credibility. It's completely wrong. The market is telling you that it has every faith that the Fed is going to be able to bring inflation down. Yeah. And the question is that they're going to, and the idea is that they're going to do it fast and hard. And that's why you can have the market still pricing 80% likelihood of a 75 basis point move this month, right now, the July meeting at the end of the month, 80% likelihood of a 75 basis point move, at the same time as you can have more and more people saying we're going to be in recession. I mean, the two things don't go together. Yeah. But yet everybody's, you have this mix up. So it's a very short and sharp rate cycle that is now being priced in. The market expects 50 basis points of rate cuts in 2023. Now that's what's now priced into the market. And you have the headline inflation fears, which Chair Powell spoke of last month with the press conference. Remember that the headline inflation and the need to get back to 2%, that's what freaked everybody out a month ago or 3 weeks ago. Well, guess what? Headline inflation, food, fuel, gasoline prices in the U.S. have been down for 21 days in a row. You barely read about it, but 2-3 weeks ago, everyone was freaking out because gas prices were over $5. Now they're under $5, $4.84 was the last price I saw on the retail basis. I saw today that wholesale gas prices fell 10% today, so they're down 25% from their peak. And this is what I mean about the money financial players now speculating in the physical space. These are moves that very rarely do you see in the physical space. A 10% move in gas, for example, that's not a normal occurrence. But what it does point out is that headline inflation fear of the Fed is self-ameliorating. It's falling, by itself. The Fed hasn't raised rates any additional amount. And yet gas, Brent, as we talked about earlier, wheat prices, copper, you name it. Pretty much every commodity is off 30% from its recent high. And so I don't really, so I really struggle. I think the inflation narrative is clearly going to come in. And the way we look at it is that if inflation comes in, then the pressure on the Fed to tighten more aggressively is reduced. If the Fed is not under pressure to tighten overly aggressively and break something, then the risk of a deep recession is also reduced.
Yeah.
And if the risk of a deep recession is reduced, then the risk of a big earnings shortfall is reduced. And if that's reduced, then arguably we've already had the derating, right? We've already had a 20% derating, even more because earnings have been going up. So you add in the earnings growth over the last year and take out the contraction of the multiple, you're looking at about a 30% move in derating terms. And that suggests that we've gone quite far. So if that whole thesis plays out, lower inflation, less Fed risk, less earnings risk suggests that the market is in a bottoming process. And that has been, and that continues to be our view, even though very admittedly a day like today, it makes you really wonder. It's very tough to sit and watch some of the positions swinging as aggressively as they are on a day-to-day basis.
No, but exactly on a day like today, suggests that the market may be bottoming, right? Because
Well,
down 2% the opening, and down the S&P flat, and what's happening to tech and rates, that's exactly what the market may be telling you today, right? And of
well, I
course,
mean,
it's only one day, but
and I was just going to say, I mean, I think, obviously it's a bigger topic, but my feeling is that, yeah, we are in a bottoming process, and there are many reasons to argue that case. And we can go into it now, or we can, if there's other things we want to talk about before we get into the markets, we can.
Let's tackle that at the end. So sure.
Yeah. So we can come back to that, but I do think that's the case. But before we get there, Roberta, one of the things I think we want to make sure we cover is the whole idea of the desynchronized mix between Europe, the U.S., and Asia, because we touched on it a little bit at the top. But, let's go back and just recap real quick. One of the reasons why we don't fear a deep recession in the U.S. or in Europe is because of the cashed up consumer, the cashed up corporate sector, the record low unemployment that exists in both the U.S. and Europe, pretty close to record low unemployment. So when you have a recession, or even when you have stagflation, which is another term people like to use a lot, you don't have record low unemployment when you have stagflation. You don't have record low unemployment when you have recession. So, for the people to make the big, deep recession call, I still struggle with it. People talk about the energy prices, causing demand destruction and no one's spending any money. Okay, well, maybe that was the case at Brent at 120 going to 140. But Brent is at 100. Maybe that was the case with gasoline going from $4.75 a gallon in the U.S. to $5.10 in the U.S. and going to $5.50 or $6. But guess what? It's going from $5.10 to $4.85 today, probably on its way to $4.50, given the wholesale price is down 25%. Retail tends to follow. So, and even before that, when you look at the percentage of of personal income that people spend on food and fuel, it's much, much less than it was in the 70s and 80s when everyone's drawing these parallels. We use much less energy to generate GDP. We're a much more service economy than we were then. Back then, we were a manufacturing economy in the U.S. and in Europe. So a lot of these things have changed. So that's the case for if a recession, and I've been pretty clear, I'm a no recession guy, but I've had to modulate that a little bit because technically the data is coming in that suggests maybe we might have a slight shallow recession. So I have to be open to that. You can't stick your head in the mud. You got to say, okay, maybe there will be a short, shallow recession, but a deep recession with record low unemployment and record high household net worth. Again, even with house prices rolling over in the U.S., the rate of change has been so great over the last couple of years. People still have tons of money in their house, tons of appreciation. So that's Europe and the U.S. Let's switch to Asia, because I
Yeah.
think this is the part that people don't fully appreciate. Asia is recovering. It's on a different path than the U.S. and Europe. Both U.S. and Europe slowing, no argument. We talked a lot about slowing growth is not no growth, or slowing growth is not recession. It's slowing growth. That's where I believe we still are in the U.S. and in Europe. In Asia, Japan is coming out of a lockdown and earthquakes and all sorts of challenges, and its PMIs are recovering and going up month by month, including most recently in June, both manufacturing and service and composite. So I believe the composite in June for Japan was the best since November. Okay, if you look at China, China's coming out, as we know, of the deep freeze lockdowns that were put in place for zero COVID. June PMIs in China were much better than expected and were the best in terms of service in over a year. So you have China, which has been the big growth engine for the global economy in the last decade. That's where most of the global growth has come from. Looks like it's on a recovery path. We talked about the government wanting to facilitate that for President Xi's reelection this fall. Japan has the same kind of pickup in its economic activity level, and you have a different policy mix in Asia. Both Japan and China have loose money and loose fiscal, right? The PBOC is not raising rates, has no plans to raise rates. They've been actually quite reticent in terms of providing more liquidity, but clearly they are. And we show the M2 chart in our monthly. China M2 is like, it's off the charts up and to the right in a major way. So they are providing liquidity. The Bank of Japan, under a lot of pressure on their yield curve control policy mix, they're not going to give that up. They don't have to give it up. There's nothing that's going to force them to give it up. And so they are also loose money, loose fiscal. And this is what I think the desynchronization, or the different, the Europe and the US or the West slowing, the East, Asia and Japan and China accelerating, maybe is what helps the global economy avert recession. And you talk about Germany, you mentioned, the complete erosion of their trade surplus. A big part of that, obviously, due to the price of imported energy, which has skyrocketed, but also a big part of it probably due to the lack of exports to China. Germany and China's a big export destination for Germany. I'm sure their exports were quite limited over the last couple of months. As China reopens, those exports should most likely pick up. But with Europe, and I know we're bouncing back and forth between Asia and Europe and in the US, but I would say in Europe, there is a challenge. Europe is challenged to wean itself off of the cheap Russian energy and develop an economy that is able to deal with more expensive energy. And that's, I think, just that's particularly a challenge for Germany. But Germany needs to accept that challenge and move aggressively. And again, that's where you go back to the end of the internal combustion engine by 2035, because Germany has a huge auto business.
And
they're pushing them.
Around,
and they're pushing them to accelerate their shift. And you look at VW, the Volkswagen CEO has been very aggressive the last couple of weeks, talking about their desire to overtake Tesla
in 2 years.
In the EV industry. And they recognize that for Germany to be successful, it needs to up its game. And I think that's going to happen. And again, right now you can buy European equity at 20, 25 year low valuation wise relative to the US.
Exactly. No, it's a great point. And so we talked about China and in you as well. And maybe we should go to chart 17, which is the one you want to most to talk about, and I think it's most important, which is how stocks react when inflation begins to come down substantially. Because it really looks like that's what we're going to see in the next couple of months.
Well, that was a chart that really stuck out at me, and it just simply shows the 1 month forward percentage change of the S&P when inflation decelerates from one level to the next, and it's I think it's about an 80-year chart, goes back post World War II period through 2021, and it's just just really interesting. It shows inflation going from 8% to 6%, from 6 to 4, from 4 to 2, etc. And my point was, the reason why I wanted to put it in was that the best performing period for the S&P is when inflation decelerates from 8 to 6%. And that was a double-digit return in the subsequent period after that deceleration. And I think that's kind of where we are today. Inflation is at 8%. I do think it's going to decelerate pretty meaningfully over the next couple of months, given what we've seen with the household, given what we've seen with food and energy prices more recently. I think that's a pretty reasonable assumption. I think that's what the rate market is telling us as well, that inflation is coming in. You have both rates and commodities suggesting that inflation is going to come in fairly sharply. This chart shows what happens historically when you have a deceleration, a sharp deceleration of inflation, because the market will immediately price a Fed that's going to either stop hiking rates or start cutting rates. And as I said earlier, we're already in this very, shortened cycle, this market speed cycle that we're having in rates. The market is already pricing in 50 basis points of cuts in 2023, which is only 6 months away. So we're now talking about a rate cycle that ends towards the end of this year or at the beginning of next year, and then immediately switches to a rate cutting cycle in a quarter or two after that. I mean, we're not, let's see how it all plays out. But I do think that, again, as we're thinking about as investors, trying to navigate a very tricky, historically unique period, we need to be thinking forward as much as we can. And that's the real challenge between thinking forward and trying to have a portfolio that's built for this shift, these shifts that we're talking about, versus the day-to-day of a day like today, or frankly, much of the last month or two, where the portfolio that is prepared for that future is getting hit in the present. So it's that ability to kind of work through a market process, which may be against your portfolio in the near term, to be positioned for the medium term. And in an environment where the market speed is so fast, you either have to try and trade it, or you have to resign yourself to taking some hits along the way to that vision or that path or that future that you have laid out, and that you, again, can articulate and support with data, such as we try to do in the monthly with our 24 different charts and tables. And this one chart, this is what you're hanging on. This is what you're hanging on for, or hanging out for as an investor. You're waiting for that inflation to roll over. It's already happened in commodities. It's already happened in rates. It's not yet really happened in equities. When it does happen in equities, you get the kind of return that the chart shows, which, as I said, double digit when inflation decelerates from 8 to 6. I think that's what we could easily see in the next couple of quarters in the second half of this year. I think we're set up arguably for double-digit type returns to the upside, as opposed to the downside, which is what we've experienced year to date.
No, exactly, absolutely, and of course, there's a lot of unknowns. That could happen, but the asymmetry, it's clearly to the upside. It looks like, and I want to reference. I remember 2 weeks ago when we spoke, you said if investors have to look at one data point, one data point, a number that was going to be energy prices. And that's totally correct, right? And they're going where they should be going, for markets to rally. And so, I mean,
Well, the only problem with that is that they've gone where we thought they were going to go, but the market hasn't rallied.
I mean,
Bits and pieces of it have, and others haven't. But again, that speaks to the idea of the bottoming process, right?
yeah.
This is not going to be a V. I don't think we're not going to have a V-shaped bottom. I think we're in a bottoming process. I think the market has clearly shown by its inability to sustain rallies that it needs more confirmation in order to really bottom fully. And I think that confirmation needs to be a clear sign that inflation has rolled over, right? Because we've waited for months for that
Mhm.
clear sign. We thought it was going to be in the spring. And arguably, if you look at core PCE, it was in the spring. Core PCE prices peaked in March.
Yeah.
And here we are in June, July, and yet headline is still high. And therefore, the market has not accepted that core PCE peak as the peak and has not manifested, an equity response. So my feeling is we're in a bottoming process. The market has not been able to hold a rally in the equities. Therefore, it's telling us it needs more evidence because it's been burnt. It hasn't the peak in inflation hasn't manifested. It needs to. When it does, and that's why we put that chart in there. We know what happens historically, and in the interim, we're watching for other things. And you have things like sentiment very supportive, valuation very supportive, but these things don't typically line up and give you a bottom, right? They're more confirmation than anything else. I think what is giving us some clear sense of bottoming is the segments of the market that went into the bear market first seem to
Mhm.
have bottomed and are leading us out. And that would be China, Chinese equities, and
And
the
innovation, yeah.
innovation space. Yep, the
Yeah.
innovation space. And so, as we talked about, China with all of the issues last year with Evergrande, remember the real estate company was going to blow up the world, and then the regulatory pressures, and then, delisting by U.S. authorities, all these issues. That was last fall, and that was the start of the China bear market, which was pretty vicious. The innovation space peaked in the first quarter of 2021. Its bear market has been almost 15 or 16 months. It's a classic down 70% type bear market, washed out completely, universally hated. Kathy Wood is like the poster child for universally hated fund managers, though I
Yeah.
don't think that's
Worse than
appropriate.
Madoff. I mean,
Yeah,
for some people,
yeah,
yeah.
which I don't agree with at all, but
No, of course,
nonetheless,
yeah.
it's the case. It just shows you how hated the space is.
Yeah.
And those two spaces, I would argue, have bottomed. We have a great chart in the monthly showing the Chinese equities bottomed in late April. KWeb, the China Tech, same thing.
Bottom of 20
Yeah,
is now
yeah.
32, right?
Oh no, China, no. KWeb is in the 40s, I believe. No, sorry, that's ARC. Yeah,
Yeah,
that's ARC
KWeb
is
is
in the
32. I
40s.
think
Yeah,
it bottom at
yeah.
20 or 21. I don't know.
Yeah, and ARC bottomed at 35, and today went out at 44, up
Yeah.
10% today, and because there's just a huge short base, it's gonna give it fuel to go to the upside, and so ARC bottomed almost a month ago, 3 weeks ago, I think like the middle of June, and Nasdaq made subsequent new lows. The ARC did not follow. And so I think those two spaces are giving us some confidence that the first in are maybe leading us out. You have the sentiment, you have the valuation issues also being very supportive. Technicals are not really supportive, right? And in this ahistorical period, I think technical analysis has taken a leadership role. A lot of people looking specifically at technical levels, in part because the algorithms that drive so much of the day-to-day trading are capable of recognizing levels, and they go right to the levels, as we've seen repeatedly. And so watching the S&P, watching to see if the lows of several weeks ago hold, is going to be really, really important. And we come to the earnings, right? So now we're all teed up. We're arguably in a bottoming process. First in looks like they're bottoming, maybe leading us out to the upside. We need that inflation catalyst, that clear confirmation. And then we also need to look at earnings because we've had the valuation derating. We discussed it already. People are universally negative. We have a great chart from B of A in the monthly that shows that profit expectations on a global basis are as low as they've been at any point in the last 20 years. So investors are not expecting much of anything in terms of profits. And there's a real bias built into this idea of recession, big earnings downgrades, and that's going to be what takes us lower for the people who believe there's another 10 or 15% down. That's the earnings cuts that get us there. So that's what we're going to get a taste of that in the next couple of weeks. And I think people are going to be much more focused on the outlook for the second half of the year, first inklings of 2023, than they are going to be on the 2020, on the second quarter 2022 numbers. And that's going to give us a sign as to the likelihood of that another big leg down. Our view has been and remains that we're in a high nominal growth rate environment.
Yeah.
And in the high nominal growth rate environment, companies are going to be able to make their earnings because they're able to pass price increases through. And again, investors are not used to a high nominal growth rate environment. Pre-COVID, the 5-year average nominal growth was about 4%, 2% real, 2% nominal in the US. In Europe, it was about 3%, 1% or 2 to 3%, 1% real growth, 1% inflation. And so here today, we're talking about nominal growth rates of about 8% in the US and Europe. And granted, much of it is inflation. And you can talk about what kind of multiple you want to put on inflation related earnings. But the bottom line is companies report in nominal dollars, revenues are in nominal dollars, profits, earnings are in nominal dollars. And if you have a nominal growth rate of 8% and you have a earnings growth rate target of 5%, you're probably going to be able to do okay. And that's where we sit. We think that even in a shallow recession, and we don't see the cases, hopefully we've articulated the case for a deep recession. Even in a shallow recession, we think in a high nominal growth rate environment, earnings growth is going to hold up okay. And if it holds up okay, and we get that confirmation of a rollover of inflation, that could set us up and should set us up for a pretty decent second half of the year. And that's really our view in a nutshell.
Yeah. No, and makes total sense. We agree. And I think, pretty soon, if not, already, people will be writing off 2022 and looking, into 2023 when things are more normalized. So just a final question, have you made any substantial changes to the portfolio?
No, but remember, that's kind of this week's, next week's business.
Yeah.
We do it after the monthly. To be honest, I don't envision dramatic changes because I think, as we talked about earlier, we've been set up for a certain view, that middle path between towering inflation and, deep recession. And we still think, even though that path may have become narrower, we still think there's a credible chance that it is what ends up happening. And as I said, we think with nominal growth in the 7-8% range, earnings should be okay. And if those things hold up, then there's really no case for another leg down in our view. And so therefore we've taken some pain. I mean, admittedly, June was not a great month for the global multi-asset model. For the TPW20 thematic model is actually better because the innovation space has been starting to bottom and pick up. And that's what makes up a big chunk of the TPW20 is innovation and climate. And the climate stuff has also been doing reasonably well, particularly in the electric vehicle space. And so we're holding, firm to our convictions. And as we talked about, you need to either try and trade this market aggressively, or you need to try and ride through it with a coherent framework that allows you to kind of suffer, to put not too fine a point on it, suffer some swings and arrows along the way on a month like June, or in the first half of the year, like the first half that we've had with market speed. In this environment, we have a framework, we have a point of view. We're comfortable with that framework. We're comfortable with the point of view, and that's what we're expressing in our models. And we think that will work out pretty well for us in the second half of the year.
That's great. Fantastic. This has been a fantastic session. And thank you again for doing this from the road. Good luck tomorrow to your son.
Thank you. Thank you.
And yeah, we'll see you in a couple of weeks. So thanks again. It's been great. I liked what I saw in the markets today. I mean, I think it was wild, but I agree with everything you said. It looks like we're bottoming, and in the second half is looking promising.
Well, and it's a process, right? Let's not expect a V. It's going to be a process, and you need to pick your spots to position accordingly. But it was a great chat. Thank you so much for bringing some of the charts and tables in. We're really proud of that as
fantastic.
Part of our work. So great that we could do that. And hopefully to your audience and to the folks in the live, check out the monthly. It's up on the OHM site, and take a look at some of these charts for yourselves. Thanks,
Fantastic.
Roberto.
Thanks, sir. Cheers. Bye-bye.
All right. Bye-bye.
Safe travels. Bye.
Thanks.